We think commodities are going to go through a period of weakness during the next 6 to 9 months, and it could be a period of significant weakness. We think that our innovation platforms are not only in prime time, they are all these 14 technologies underlying the 5 major platforms: DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology. They are moving into the sweet spots of S-curves. And the convergence between and among these technologies is going to cause some explosive growth, but is also going to cause what we call creative destruction. So the traditional world order is going to change fairly significantly, much more rapidly than we believe investors now anticipate. Of course, Bitcoin which we still believe is the reserve currency of the crypto asset ecosystem. Understanding that stable coins could be giving it somewhat of a run for its money. There are demographics that are supporting a number of markets. Did one very simple thing. He calculated the percent of consumption that baby boomers would account for in the 80s. And it looked like it was going to go up through the 80s and the 90s. And he concluded that, therefore, that this young workforce, as it evolved and gained more wealth, would be very good for stocks and would probably be it wouldn't be as beneficial for bonds, but it would be helpful for financial assets generally. Based on demographics, that the market won't peak until the number of millennials peak in 2038. And he believes that the equity markets should enjoy a 20% compound annual rate of return through 2028, so the next 7 years, lucky 7 years. Well, having watched how powerful that variable was in the 80s and 90s, against all expectations, there was a lot of bearishness in the 80s, and most of it was around inflation, interestingly. That this is going to play out exactly the same way this time around. But I do, and especially if we're right on autonomous vehicles, we think auto sales are going to come down. We think they peaked, just like oil, we think they did peak in 2019. But that said, that's even more interesting because there will be more purchasing power for other goods and services. When I was growing up, I had to prepay for my transportation in California, which did not have a very good mass transit program. What's been interesting about the correlations, Bitcoin to any other asset class, is the correlations have actually been very, very low over time. In fact, the highest correlation is between Bitcoin and real estate. Now, the IRS taxes Bitcoin as property, but I don't think that's the reason for this correlation. It just so happens it's that. So we think that as it becomes a better accepted new asset class, and we are seeing institutional movement into the space, and we're seeing the diversification of balance sheets from cash into Bitcoin, we do think it will behave, actually, I would say, more like the fixed income markets, believe it or not. If you think about bonds from this level, this idea of a 60-40 balanced portfolio is a bit problematic. We've been through a 40-year bull market in bonds. We would not be surprised to see this new asset class become a part of those percentages, maybe 60 equity, 20-20. So I actually think that might be the biggest surprise here. One other thing on demographics, the three areas where we believe millennials will spend, and I believe Fundstrat would agree with this, certainly stocks, housing, yes, don't think innovation is going to change that so dramatically, except maybe houses without kitchens, so there will be much more in the way of food deliveries. But of course, this demographic is very interested in crypto. Of course, Bitcoin is, which we still believe is the reserve currency of the crypto asset ecosystem, understanding that stable coins could be giving it somewhat of a run for its money. When the technology platforms shift, it's very hard for DNA to shift from old to new. That said, you've seen with Walmart, you're going to have a Walmart, a Target, a Costco. So you'll have maybe 2 or 3 mega banks. And yes, a lot of them are investing aggressively now, which is what they should be doing. But we do believe that the 2 of the biggest sectors that will be disrupted in the world today are the 2 that have been best performing this year: energy and financial services. So choose wisely and make sure you're on the right side of change. Make sure these companies are investing enough, have invested enough. So many companies simply leveraged up to buy back shares, and now they're facing this huge investment mandate. So make sure that you invest in those that will be the survivors. And we do think that the carnage is going to be pretty significant in both the energy and the financial services sector long term. Now, in a V-shaped recovery, and we think we're in a very strong recovery right now, they're going to do fine. They're going to do fine. And in fact, the yield curve is very wide by recent standards. So that should accrue to the benefit of financial services, the reserve currency of the crypto asset ecosystem. And in fact, a lot of this is based around network effect and the security of the network, which is all important when it comes to transferring large sums of value. And so our confidence in Bitcoin has not diminished at all. Our confidence in looking at the Turkish lira in some of the emerging markets currencies is diminishing. And I think that will continue to be a very fertile area of growth, meaning the emerging markets, individuals diversifying into crypto assets. As well as those of us who just want insurance policies against any confiscation of wealth, whether it is inflation, and as you know, we don't think inflation is the problem in this country, but if we're right, it could mean that inflation in other countries, meaning emerging markets currencies especially, in unstable regimes especially, could become more of a problem. So I'll just wind up on this idea of deflation. We do think now we have 3 sources of deflation. I described the cyclical one. We think commodities are going to go through a period of weakness during the next 6 to 9 months, and it could be a period of significant weakness. We think that our innovation platforms are not only in prime time, they are all these 14 technologies underlying the 5 major platforms: DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology. They are moving into the sweet spots of S-curves. And the convergence between and among these technologies is going to cause some explosive growth, but is also going to cause what we call creative destruction. So the traditional world order is going to change fairly significantly, much more rapidly than we believe investors now anticipate. And we believe that the pricing power of in the old world order will diminish, especially because so many companies leveraged up to satisfy short-term oriented shareholder demands for their profits now and their dividends now, as opposed to sacrificing short-term profitability to invest in innovation.